This small European stock is a contrarian buy. X-Fab Silicon Foundries is a Belgian company that makes microchips for the automotive, industrial and medical industries. At the current price, the company has a market value of 646 million euros and an enterprise value of 662 million. Revenue over the last 12 months comes to 777 million, with 97 million of net income and 185 million of EBITDA. Free cash flow, however, is negative due to a large increase in investment spending. So Xfab stock is currently valued at under 7 times earnings and 3.6 times EBITDA. Xfab stock has fallen 50% this year as a slowdown in electric vehicle sales and medical devices have affected demand for its chips. Geopolitical events like the Ukraine war and the pandemic also caused companies to stockpile chips, which still hasn't normalised. As a result, Xfab's total revenue is up less than 2% on a trailing 12-month basis. Silicon carbide sales were down 60% in the third quarter and the industrial segment fell 41%. But Xfab remains well positioned for long-term tailwinds like electric vehicles and the energy transition. Our management is optimistic that the cycle is near a bottom. Crucially, despite short-term weakness, Xfab revenues have been well supported by its 180 nanometer chips, which are now running at close to full capacity. It's confidence in the 180 nanometer that has led management to provide an optimistic 5-year outlook and an ambitious investment plan. In a recent presentation, Xfab said it was investing $1.1 billion on new production facilities and automation equipment to boost capacity. In support of those plans, management projected a 28% revenue increase by 2026, with EBITDA margins rising to 30% and free cash flow of $155 million. And that's expected to rise even further by 2030. If Xfab is able to hit those targets, the stock should be a big winner. For example, if you assume $155 million of free cash flow in 2026 and the company trades at only 10 times those cash flows, the company would be worth about $1.5 billion, more than double today's valuation. Of course, there are some risks. A lot of Xfab's revenue is tied to Chinese auto sales, which could face pressure from tariffs. Xfab's investment plans will require some debt, and projections for 23% annual growth in silicon carbide and 23% growth in medical revenue seem optimistic. Xfab management has already had to lower expectations several times this year, but Xfab stock is already pricing in a lot of bad news at under 7 times earnings. So if the company gets anywhere near its forecast, the stock should do very well. But these are my personal opinions, not financial advice, and I do hold shares in Xfab. For more investing videos, make sure to visit my website at 3minutebreakdowns.com. Thank you for watching.